All right, let's jump right in. Right now, behind the scenes of global finance, there is a massive architectural test happening. It's essentially a collision between the fast-moving world of private stablecoins and the highly regulated world of public digital currencies. In this explainer, we're going to decode the Bank of England's latest digital pound experiment, giving you a sharp look at the real business signals hidden inside their recent trade finance test. But right off the bat, I want to be crystal clear. This explainer is strictly for educational and informational purposes. We're looking at the technology and the macroeconomic signals here, so absolutely none of this is financial, investment, legal, or business advice. Okay, let's get into it.
So, this brings us to the overarching question framing our entire explainer today. Who really controls the future of money? You know, when we read the headlines, it's so easy to picture this as a giant cage match between central banks and private crypto networks. But the premise we're going to uncover today is that the real battle isn't about which currency actually wins. The true contest is about who controls the bridges connecting them.
Here's our roadmap for today. 1. The digital pound experiment. 2. The trade finance problem. 3. Bridging public and private. 4. The hidden control layer. 5. Winners, losers, and risks. And 6. The signals to watch.
Part 1. The digital pound experiment.
Let's start with the nuts and bolts of what the Bank of England actually did here with a consortium of players, specifically NOBO Finance, Dun & Bradstreet, and Polygon Labs. First things first, we have to separate fact from fiction. If you follow this space, you've probably seen some pretty breathless, hype-filled headlines recently. But let's step away from the crypto bro excitement for a second and look at the mundane reality of trade compliance. Fact: this is a controlled, simulated trade finance experiment happening inside the Bank of England's digital pound lab. It uses completely dummy data and simulated money. Fiction: Britain is launching a live digital pound or officially endorsing Polygon. Actually, the UK hasn't even decided if it will issue a digital pound yet. The core demonstration ledger they used literally just runs on a conventional relational database with a totally separate platform testing the smart contract interoperability.
So, what exactly are they testing in this simulation? Well, the project is split into two connected work streams. Workstream 1 is all about creating a reusable SME Bankable Profile. Imagine combining transaction data from a digital wallet with commercial intelligence from a giant like Dun & Bradstreet. The goal here is to let a small company prove its identity and its creditworthiness just once, and then carry that approved profile around instead of starting from scratch with every single lender. Workstream 2 is where the money actually moves, programmable invoice financing. They're testing a workflow where an exporter gets an advance payment in a private stablecoin using infrastructure from Polygon's open money stack strictly for objective testing, of course, while the UK importer ultimately settles the bill in simulated digital pounds, with the whole shebang coordinated by NOBO Finance.
Moving on to Part 2, the trade finance problem.
To really understand why on earth they're mixing private stablecoins with simulated government money, we need to look at the massive friction currently choking global trade. And right at the center of this is something called invoice factoring. Simply put, this is financing that advances cash against an unpaid invoice. Think about it. A small business ships a huge order overseas, but their customer might not pay for 30, 60, or even 90 agonizing days. So, a financer steps in, gives the exporter cash up front, and then takes repayment when the final settlement finally happens. It sounds simple on paper, but in the real world of international trade, it is an absolute headache.
The crucial takeaway here is that trade finance is basically a massive coordination problem disguised as a payment problem. Just look at this sluggish relay race. Step 1, you have to verify identities across borders. Step 2, check physical and digital paper trails. Step 3, confirm the goods actually arrived. Step 4, reassess the credit risk. And finally, Step 5, execute the settlement. Every single manual handoff here requires insurers, logistics providers, and compliance teams to agree. And while they're endlessly exchanging emails and reconciling spreadsheets, a small company's working capital is entirely trapped, totally restricting them from taking on their next order.
Section 3. Bridging public and private. This brings us to the absolute core of our analysis. This experiment is asking if reusable credentials and programmable smart contracts can compress those painful handoffs. But in doing so, it reveals a massive, hidden architectural shift. We are so used to hearing that central bank digital currencies, or CBDCs, are going to wipe out stablecoins, right? Or vice versa. But this experiment proves they don't have to be rivals at all. They just have different jobs. Private stablecoins are being utilized for faster cross-border funding, providing that quick cash advance. Meanwhile, the public central bank money is used to anchor the final safe domestic settlement. They're totally complementary.
Let's use an analogy to really cement this, because it's a real game changer.
Think of international trade as a complex journey requiring several different rail systems. The stablecoins, the bank deposits, the potential digital pounds, these are just the different trains. But here is the secret. The most valuable company in this ecosystem might not own a single train. The real power lies in owning the station, the identity checks, the ticketing system, and the switches that let passengers and cargoes seamlessly move between those different trains.
Which leads us to part 4, the hidden control layer.
That brings us right to the strategic implications of this new financial bridge. The shift is moving from whose token wins to whose bridge becomes the default, because if public and private money are going to interact, someone has to facilitate it. Look at the specific components of this strategic control layer: identity standards, wallet access, the rules for compliance, the actual currency conversion, and the transaction routing. Whoever controls these interoperable elements, they collect the toll fees. But more importantly, they get to shape exactly which financial products even reach the customers in the first place, even if they aren't the ones issuing the underlying money. Make no mistake, that is a massive centralization of power disguised as open infrastructure.
All right, part 5, winners, losers, and risks.
So who actually benefits if this interoperable vision becomes reality, and who is staring down the barrel of obsolescence? Let's break down the market signals quickly. The potential winners are pretty clear. Small and medium enterprises, or SMEs, and exporters who get faster verification and earlier access to their much-needed working capital. Infrastructure providers win big because, well, they're selling the connective tissue. Banks and alt lenders win by expanding underwriting while slashing duplicated KYC checks. But look at the right side. Much more exposed are the manual intermediaries. Anyone whose job is repetitive document checking faces massive automation pressure. Closed payment networks that rely on trapping customers inside a single rail will weaken. And crucially, small firms with thin, weak, or inaccurate digital records risk being entirely excluded by these new automated, data-driven underwriting algorithms.
But hold on, before we get too carried away, we absolutely need a reality check. A successful tech demo in a lab does not mean this works seamlessly at scale in the wild. Tech success is not commercial success. Why? Because real-world trade is messy. Real disputes involve a shipping container full of damaged goods, sophisticated fraud, geopolitical sanctions, and complex human judgment calls that smart contracts and code simply cannot automatically resolve. Furthermore, portable financial profiles create immense privacy risks. Think about it. If a data firm makes an error on an SME's profile, that bad data could follow the company from lender to lender, locking them out of capital instantly. Programmability reduces delay, sure, but badly written rules can automate the wrong outcome at the speed of light.
Finally, part 6, the signals to watch.
So, as focused learners trying to cut through all the noise, what should we actually be paying attention to? Here is the timeline of what to watch. We are currently observing the Phase 2 lab, which remember is strictly simulated testing. The next major signal will be the Bank of England's final Phase 2 findings. And when that comes out, don't just look at whether the tech worked. Look for measurable data. Did it actually result in measurable reductions in verification time, settlement delay, and financing cost? Finally, circle 2026 on your calendar. That is when the Bank of England is set to make its official decision on whether to proceed with the digital pound blueprint.
And just to firmly anchor us back in reality, here is a direct quote from the Bank of England regarding these labs. Participant demonstrations reflect experimental choices, not future bank policy or endorsement. Always remember, when you see a tech company issuing a flashy press release about working with a central bank, it is a controlled experiment, it doesn't guarantee commercial production, and it certainly doesn't guarantee future government policy.
So we've seen that the future of money might just be this incredibly connected stack of public stability and private speed. But it leaves us with one incredibly important question to ponder. As these standards become portable and these financial networks intertwine, whose bridge becomes the default? Will this incredible interoperability become an open, neutral infrastructure that truly democratizes global trade? Or are we just watching the construction of yet another privately controlled toll road? Keep your eyes on the control layer.